Okay.
So here, different picture. Not everybody in the space is touching aluminum, but this tends to be the lion's share of what I do on a daily basis. It's the most actively traded metal and very big in the manufacturer and beverage space. So like I said, it's the majority of what my day basically is. More of a market-driven, you can see much more jagged lines, meaning that it's not just undulating with these larger moves. There are actual supply and demand factors that are coming into play every day, or people that come in and make a big purchase every day because this market's very active. We see these last two kind of shots upward, probably since May, both of those directly related, not to anything with aluminum, but both with government announcements, both domestic and abroad, of government easing, particularly like right around, I believe, June, like June to September. We're seeing a shot up from $1,800 a metric ton back over to $2,200. If I had a laser pointer, I would point that out. That was really only a point of 1 week where people were feeling that the government's going to spend their way out of this. It's not related to demand, but you look at copper, you look at aluminum, you look at gold, a lot of physical assets went shooting up, only to be met with more negative headlines to bring it right back down before the end of the year. We're muddling around between 2,000 and 2,100 at this point because people are looking for the U.S. government to take further action as they have other budget meetings coming through the end of February and other further meetings on the debt ceiling to see what they're going to do. But for nearly all of my customers, it seems like this year is such a slow year to start for sales. Just usually they have this seasonal pickup in demand, and that hasn't happened yet. Maybe it's delayed, but January we usually get quite a few orders for longer-term purchases, and that hasn't happened.
Tony, you had said that the steel industry is kind of old school in its approach to pushing through price increases in contrast to the aluminum and copper guys.
Yep.
What approach do the aluminum and copper guys use? Is it more selective? Is it more cost-based driven?
It is. It's actually it tends to be very transparent, and it's just very formulaic. So for steel, you just might get a letter in the mail or in the email that says your prices are going up $50 a ton. It is what it is. Where in aluminum, a lot of sales deals are booked on, volume, and then also kind of like a percentage or like a known charge. So they'll give you a floating price based on an index, whether it's the LME index or the Midwest Premium Index, combined together. And it's really a product of the fact that both the producers and the consumers want to be able to buy like a good quality product, a known quality product, but be able to hedge it either physically or financially. And they've been very active in using these price indices and hedging for over 15, 20 years. Because everyone's comfortable with that, it makes it a lot easier to be transparent when you're doing transactions. The hedging market for steel itself has really only existed since 2010, and a lot of folks in that space have just been reluctant to adopt it because it seems like it's a fancy new tool. It's different than how things have gone before. Most of the large service centers are playing in it because their customers demand a fixed price. They want to take some risk out. But a lot of the manufacturers are not that far down the path yet.
How has that hedging market developed versus how you thought it would have done? What have been surprises for you in the hedging market development?
The volume has increased quite a bit, but what's interesting is it's the same. I mean, it's more than a dozen, but I say that like the usual dozen folks, the large service centers, that are in it all the time. So I would have thought that with these huge price swings, that more end users would have gotten involved, and it seems like they're more and more pushing back or pushing the burden upon the service centers. And that development was, I wouldn't say shocking, but it was a surprise to me because I think that people like to take matters into their own hands, and I don't know what the service centers are charging for it, but they're certainly not doing it for free. But yeah, volume is definitely, it started in little nibbles and bits and pieces of, several hundred tons to 1,000 tons, and I mean, we're seeing a lot more tens of thousands of ton 3- and 6-month transactions on a pretty regular basis.
I wonder if companies look at buyer deals with service centers with a little less scrutiny than they do buyer hedging deals. And so from a buyer's perspective, that's a good question. We should ferret out and see. Jim's head's kind of going up and down when I ask that question.
Yeah, well, I mean, that'd definitely be a good one to address because it's not something that I would see. You know, I hear of one side and then I'm on a part of the other one, but I've actually never heard of, if I'm working with a large public service center in Chicago and they're getting a hedging price from me and giving to their customer, I've got no idea what their markup or what they're doing to it. So whether it's their choice to make it look good or bad. So it'd be interesting to hear.